Alrighty. So in today's video, we're going to be talking about the cover call strategy for small accounts. So how exactly should you be trading the cover call strategy if you have a small account? And more importantly, how do you go about doing the stock selection, especially if you don't have that many stocks that you can choose due to the limited size of your account? So not too long ago, I was pretty much asked this very question. So as you can see over here, this is somebody that has asked me this question. So the question is this: Hey Davis, thanks for sharing your knowledge. How can I select companies to use with the cover call strategy if I have a small account? I like to choose stocks that is less than or equal to $20. I have a couple of stocks like Riot, INTC, etc. But the premium in those cases is very low. So as you can see, if you do not have that big of account, then the stock selection is going to be a little bit challenging. And unfortunately, you don't have that many choices that you can go for, because my preference when it comes to the cover call strategy is to go for stocks that are actually considered fundamentally strong. So if you go for stocks that are less than $20, usually there is not that many selection. So what do you do in this case? First of all, there are two options that you can do if you want to trade the cover call strategy with a small account. So the very first option is like what this person pretty much have been doing, right? Just buy 100 shares of low price stocks and sell a cover call on it. So the cover call position is pretty much just 100 shares of stock and then a short call option for them. Okay. Now this is the first option. Now the second option is that you can actually trade the PMCC on higher price stocks. And with higher price stocks, you can actually have much more selection in terms of choosing better stocks, because the higher price stocks usually are the ones that are fundamentally good stocks. So choosing this kind of stocks is actually my preferred choice when doing the cover call. But because you have a small account, instead of trading the traditional cover call strategy, what you can do instead is to trade the PMCC, as I mentioned here. So what is the PMCC? So the PMCC, in case you're not aware of, it's called the poor man's cover call. And no, you do not have to be poor to trade this strategy. Basically, it is a synthetic position to kind of mimic the cover call strategy, but this time using options. So the poor man's cover call really is a combination of two options. So you have the deep in the money long call plus the short call. So as you can see over here, instead of the 100 shares, you're replacing it with the deep in the money long call. So how exactly do you construct this poor man's cover call? Okay, so as you can see over here, this is the option chain of NVIDIA, and I'm going to use NVIDIA as an example because NVIDIA is one of the stocks that quite a lot of people have been talking about, and it's also what I consider a fundamentally strong stock. Okay, so before I get into that, I want to first show you how you can construct the poor man's cover call on NVIDIA, where the price is actually pretty high, around $142, which is much higher than the $20 which the person was actually asking about. So if you were to buy 100 shares on NVIDIA to do the covered call, it's going to easily cost you about $14,000, because 100 shares times $142 is going to be $14,200. So it's going to be a little bit out of reach for you to do the covered call strategy on NVIDIA if you don't have that big of account. However, we can still have the cover call strategy using the poor man's cover call. So I'm going to show you how to construct it. So first off, we want to look at the deep in the money long call. Where exactly do you buy this call option? So we are looking at somewhere around 60 to around 120 DTEs. So anything within this range is going to be pretty okay. And we want a longer dated one compared to the short call is because we want to have a few cycles of the covered call, right? So if you know the covered call strategy, basically you have 100 shares and then you're just selling the covered call. Once the covered call basically expires, you can sell another covered call and you can keep doing this again. However, with the options, there's going to be an expiration date. So if you're going to choose pretty much the same expiration date for both the long call and the short call, then it's going to be a vertical spread instead. So if you choose a longer dated call option for the long call, then you can actually sell the cover call at a shorter date and you can cycle it a few times. And another reason why we want to go for the further dated options is because of the theta decay. So generally when we are selling options, we want to go for the shorter dated options because we want the theta decay to really kick in, because it really increases as it gets closer and closer to expiration. But when we are buying option, it's going to be the opposite. We do not want the theta decay to kick in that quickly. That is why we're going to a further dated DTE. So let us first establish the long call over here. So for this, I'm just going to choose the 100 DTE, and we are going to choose the deep in the money long call to purchase for this. So how deep in the money should it be? So this is where we can go somewhere around 70 to 80 and maybe even 90 deltas. So the reason why we want to go for this pretty high delta rather than at the money is because of the extrinsic value. So this is where the theta decay actually affects the option. So when we are talking about theta decay, it's the decay in the extrinsic value. So this extrinsic value will actually gradually goes to zero over time when it reaches expiration. So as much as possible, we want to reduce this extrinsic value when we're buying. And if you were to go for the higher deltas, this is where you can see over here, the extrinsic value is much lesser as it goes deeper in the money, right? But at the same time, you notice that the cost of this option is going to be much higher than if you were to go for a lower delta. So as you can see over here, if I was to go to the 70 delta, so let's just go for this one, 71 delta, you notice that the price is much lesser. Is $22 compared to $50 over here. So it's less than half the price. And the trade-off of this is that you're going to have a higher extrinsic value. So remember, when we are buying options as much as possible, we want our extrinsic value to be as little as possible. And when we're selling options, we want it to be as high as possible. So that is why we go for the higher deltas when it comes to the long call option for the poor man's cover call. But of course, there's no need for you to go all the way until so deep in the money, because by that time, you can see over here, it's just going to increase in price. So we want to have a nice balance between the two. So in this example, I'm just going to go for the 70 delta one, which is more than enough if you're going to construct the poor man's cover call. So as you can see over here, if I was to construct the poor man's cover call with this long call, how much is it going to cost us? So you can see over here, it's going to cost us $22.35, which equates to $2,000, $235. So you can kind of have a long stock position, a synthetic one, but the difference is that you actually do not put that much. You only have to fork out $2,200. And we can even make this even lesser when we start to sell the covered call on this. So we are going to go to the covered call part where we sell the call option. So for this, we want to go to a shorter dated option. And I like to go for somewhere around the 45 DTEs one for the poor man's covered call, because this is where we're going to have our edge. So in case you're not familiar with what this edge is, it's basically that when you go for 45 days and above, this is where we have an edge when we are selling options. So I've already created another video where I go in depth into this, so I won't talk about this in this video. So you just have to know that when we're selling the covered call for the poor man's covered call, just go somewhere around 45 DTE. And for this, I'm just going to go with the 43 DTE. So what is the delta that we're going to choose for the poor man's covered call? So if you have seen my other videos on the covered call strategy where we have 100 shares, you'll notice that I tend to choose around 10 to 15 deltas for that. And the reason for that is because we have 100 shares. So 10 to 15 deltas is a pretty distant away delta strike price, right? That we won't be caught away that often. However, for the poor man's covered call, because we do not actually have the 100 shares for us to get called away, instead we have the long call option, I want to actually be a little bit more aggressive with my covered call. And this is where I would go for somewhere around 20 to 30 delta. So let's go for maybe the 155 strike price, which is around 26 delta. So as you can see over here, after I have sold this call option, my total for this poor man's covered call is $19.60, which is equals to $1,960 for you to put up a synthetic covered call position, which is the poor man's covered call. And what you notice is that now, even though you have a small account, you're still able to put on the covered call strategy using options alone. So with the poor man's covered call, no longer are you restricted to just a very small pool of stocks that is much lower price. But now you can actually go for higher price stocks, like for example, Nvidia. And this is where you can actually have a better selection of stocks, because like I mentioned, usually the higher price stocks are the ones where you have the fundamentally good stocks. Okay, so the next important question that I want to get into is basically, which is the better option? By the way, if you like this video so far, please subscribe and also click the thumbs up button, and also do get your free copy of the Options Income Blueprint, where I share the top 3 option strategies that help you generate a consistent income each month trading just 1 to 2 hours a day, right? So if you want to go ahead to get this copy, just head on over to optionswithdavis.com/blueprint. All right, back to the video. So I've shared with you the 2 options that you can do the cover call strategy on if you have a small account. So the very first option is to buy 100 shares of low price stocks and to sell a covered call on that. That is the most cleanest way to do a covered call strategy. And you have option 2, and that is to trade the poor man's covered call on higher price stocks, where you can access those fundamentally good stocks, and you can have pretty much a very similar position as the covered call strategy, but this time using only options. So of the 2, which is a better choice? Now, for me, my preference would always be option 2. And the main reason is because for the covered call strategy, the stock selection is actually the most important part, because you can go for the low price stocks, but if this low price stocks doesn't actually go up, then guess what? You're going to lose money on your covered call position. So that is why option 2 would be the preferred choice. Now, of course, there's going to be some trade-offs, because if you go with option 1, you can hold on to the stocks for a long period of time because there's no expiration date on your stock. So if you're the kind of person that really like the stock a lot, then if you go for this option, then yes, you can just hold on to the stocks for a long time. But the problem with this option is that you usually do not have fundamentally strong stocks, and that makes it more challenging for you to actually be profitable on the strategy itself. So let me just show you an example of what I mean over here. So as you can see, this person over here have mentioned Riot. So let's take a look at Riot. So if I was to go to Riot over here on the chart, let's take a look at the price action. So if I was to zoom up to, let's say, the weekly time frame, take a look at how the stock has been performing. So the cover call strategy is a bullish strategy. That means to say, you want the stock to actually go up over the long term in order for the strategy to be net profitable over the long term. But if you get into the stock when the price is somewhere around here, then as you can see over here, it's going to be pretty difficult for you to be profitable on the covered call strategy. And let's take a look at the longer term as well and see how has this actually performed over the past number of years. And as you can see, Riot is really going to be a very difficult stock for you to be profitable if you're going to trade the covered call strategy, especially you can see over here. If you had entered somewhere around here, then guess what? You're most likely going to be stuck in this stock all the way pretty much until now. So the cover call strategy on Riot is just going to be very, very difficult. And this is a common pattern where the price of the stock actually just collapsed from very high when the company is actually not fundamentally strong. That means it's not even profitable over the past few years. So if I was to go to finance, Google, all right, over here, Google Finance, and if we take a look at Riot to see how well it has been performing in terms of the income statement, you can see over here, right, if we click on this annual, it has actually not been consistently profitable. Now, of course, in 2024, it's profitable, but before that, you can see that it's not profitable, and it pretty much has reflected in the stock price. But what if we talk about fundamentally strong stocks? So let's say, for example, Nvidia. So let us take a look at Nvidia and see how did it perform in terms of the profit and loss over the past few years. You can see that over the past few quarters, it's been profitable, right? The net income and the revenue pretty much have been growing. And if we take a look at the annual income statement, you can see that it's pretty much increasing as well. So remember, all the stocks that we're trading are all companies. And if the company is actually not profitable, then usually it also translates to a very volatile kind of stock price movement, whereby you have seen in Riot. So let's take a look at Nvidia. How did the stock price of Nvidia do over the past number of years? So if we click Nvidia, you can see that Nvidia has just been going up, right? So again, this is something that you see is pretty common when you trade with this fundamentally good stocks. Now, of course, not all the time, but at least it's going to be much safer compared to if you choose stocks that is lower price, but they are not fundamentally sound. And that's where you can get into trouble if you're trading the covered call. Now, the next thing we want to look at is the statistics of the covered call strategy as to how it would have performed for both Riot as well as Nvidia over the past 5 years. So this is important because this is how we can have an idea as to whether the strategy will actually perform well on the stock itself. So over here, this is the backtesting tool of Tasty Trade, and we are just going to run the backtest of the covered call strategy as much as possible to try and simulate it to see how it would have done on both Riot as well as Nvidia. Now, one thing is that for this backtesting tool, it's a little bit limited in the sense whereby we can actually run the covered call strategy or even the poor man's covered call strategy in a certain sense. So instead, what I'm going to do is I'm just going to put on this call debit spread where I'm going to use 100 DTE, whereby the main goal down here is to just take a look at the win rate, because the win rate by itself would already depict how many times that the covered call position would be in profit. Because the main goal down here is that the stock has to go up in order for the covered call position to be profitable. So if you were to do the poor man's covered call strategy where you sell the shorter term covered call, you can keep doing this until to the point whereby the covered call will be on the same DTE as your long call, making it into a vertical. So I'm just going to simulate the covered call strategy with this vertical down here, and just to take a look at the win rate by itself to see how well the covered call strategy would have done over the past 5 years. So I'm going to start off with Riot, and I'm going to hit the run backtest button, and let's just wait for the results to load. Okay, so as you can see over here, for the past 5 years, this is going to be a net loss. Now let us take a look more importantly at the details, because this is where I want to take a look at the profit rate down here. So as you can see, the profit rate is going to be 50%, which means to say that 50% of the time when you put on the covered call strategy, it will be profitable, but 50% of the time it's going to be in a loss. So let us take a look at Nvidia and see what kind of a profit rate we can get on that when it's going to be a fundamentally good stock. Okay, so we have Nvidia over here, and everything else I'm just going to keep the same, and I'm just going to run the backtest, and let's just wait for the results to load. Okay, so the results are out, and as you can see, the very first thing you would notice is that there is a profit, and it's not just a small profit, it's a profit of over $116,000. And it's not that surprising because over the past 5 years, Nvidia has just been going up. And this is one of the positive things when you're choosing a fundamentally strong stock. So let us take a look at the details and take a look at the win rate. And straight away, you can see that the win rate is significantly higher compared to if you did this on Riot. And this profit rate is based on you just putting on this trade over and over again without even timing your entries. And if you can time the entry well, then it's certainly possible that you could get a higher profit rate. So out of these two stocks, needless to say, when you put on the covered call strategy, you're of course going to have a higher chance for you to be profitable when you're trading on Nvidia compared to if you trade on Riot. So that is why if you have a small account and you want to trade the covered call strategy, out of the two options, option 1 where you buy 100 shares of low price stocks and sell a covered call, versus option 2 to trade the poor man's covered call on higher price stocks where you can get access to fundamentally good stocks, I would always go for option 2. So hopefully you found this video helpful, and if you have, I would greatly appreciate if you give me a thumbs up on this video, and also subscribe to my channel for more options trading videos like this, and I will see you in the next video.